I have actually printed out here best performing stocks in the S&P 500.
People don't really know this. Companies have been working on AI the last 10 to 15 years. We've seen a lot of situations where people have done this and were very concentrated in a sector or a company, and those things can overnight drop 50, 60%.
If you have a position that has done so well for you over the last 10, 15, 20 years, it's so hard emotionally to get rid of it because it's been so good to you.
Let's protect the wealth. And so definitely some careful planning needs done.
And so one of the strategies that we do, I'll start with direct indexing.
The strategy is, it's called NUA, which is net unrealized appreciation.
If you're charitably inclined, a donor advised fund makes a lot of sense.
An ETF tax-free swap. So essentially there's generally minimums to do this.
If you feel like you're in a lower income year, it could be a good time to realize some tax favored strategy.
Concentration is a really great way to get rich, is the way to stay rich.
So Jamison, right now the S&P 500 is really dominated by the Mag 7, the Teslas, the Alphabets, the Metas, etc. A lot of people have a lot of exposure in large cap in the S&P 500, and a lot of people have exposure in those individual positions as a whole. If we're analyzing people's portfolios, we're seeing sometimes holdings in the 50 to 60% range of someone's overall net worth. What's the problem with that? And then we'll just get into some strategies for those types of situations.
Yeah, so I think really if you look back at the last 25 years of the S&P 500, it's been like, I think, the biggest booming period ever. And one of the big reasons is for the wealth creation with AI and tech. So obviously there's the dot-com boom, cell phones, internet, and then really the last, people don't really know this, but the last like 10 to 15 years has really been as long as these companies have been working on AI. It's really just been the last like 3 years that it's been in headlines with ChatGPT being released. And so we've seen this big wealth creation opportunity of people that have invested in the Mag 7s that you have explained. Will it continue? We're not going to speculate. It might. But we've seen a lot of situations where people have done this and now they're nearing retirement. And what the problem is, number one, we're very concentrated in a sector or a company, and those things can overnight drop 50, 60%. The second thing is from a tax standpoint, it becomes a very big tax problem on how you're going to actually unwind this, because not only are you juggling taxes, but you're also juggling the risk of that sector or stock getting cut in half. And you have to sell it to live on, then you have to pay tax. There's a ton of issues that come with this. And so definitely some careful planning needs done.
Before we jump in, I just wanted to say there's going to be a lot of financial strategies that we're going to have, a lot of tax saving strategies that we're going to have, but almost a bigger issue is just the emotional side of this. I mean, if you have a position that has done so well for you over the last 10, 15, 20 years, it's so hard emotionally to get rid of it because it's been so good to you. Sometimes we're talking with people that work for a company that have a bunch of company stock, and it's just, it's their salary. They believe in the company. They've been there for years. Same thing with holding one of these individual positions. They've been a believer in it for years. So it's hard emotionally to unwind that position. But mixing emotions and investing, it's like oil and water. You really gotta avoid it if you can.
Yeah, that's a really good example. I think it's a really good place to start. Is before we even get into the technical side, we got to understand the emotions and the psychology behind it. So a lot of people are emotionally tied to these. It's created a lot of wealth. I like to frame it as concentration is a really great way to get rich. Diversification is the way to stay rich. So when you're trying to accumulate wealth, you kind of need to find, you don't need to, but a lot of people will get wealthy by finding that needle in the haystack. You're finding this one thing that's going to get me really wealthy. Once that occurs, now we need to just buy the haystack. We don't need to take these bets on these individual things. We just need to own everything, or as much as we possibly can, which is a good analogy for diversification. But I think before we get into the tactical stuff, it's really creating a decision-making framework of, we're going to make the decision now before emotions get involved of stocks up, stocks down, because that's when people get emotional. We're going to make the decision now and set this framework of, hopefully the market's up, because usually people are a little bit more euphoric, but we're going to make this decision now of some exit strategy of whether it's every quarter, every year, every 6 months, every month. Doesn't matter what the market's doing, we're going to just get out of this position in a systematic way that is not tied to your emotions. So that would be one framing. And the second framing is, what do you need to secure your financial goals? So how much money do we need to be diversified to make sure that college, if that's still in the picture, financial independence, legacy, all that stuff is in place. And then beyond that, we can invest however we want. So Ben, give an example of like how we would make those types of decisions.
But before I do that, just one more note on the emotional side of things. This all comes back to the theory of just regret minimization. Like oftentimes we'll walk through, I love this example. Let's say a client has like $2 million worth in a one stock position. You can ask them, hey, what would evoke a stronger emotion from you if you sold it and it went from 2 million to 3 million and you missed out on that $1 million growth, or if you didn't sell it and it dropped from 2 million to 1 million? What would make you feel stronger? And I think 9 times out of 10 people will say, well, I would feel stronger if it went from 2 to 1 and I didn't do anything than if I sold it and it went from 2 to 3. So it's just this idea of getting clients to wrap their head around the idea of selling it, just in the sense that we want to make sure that we're taking almost like opening the door that is going to make them feel better than in those two options. So I always like walking clients through that.
Basically, the downside's worse than the
upside
of a double or a 3x or something.
Exactly right. And so one of the strategies that we do when we get people to think, okay, I'm ready to take some chips off the table, first things that we like to do is, I'll start with direct indexing. It's a tax loss harvesting strategy that mirrors index investing. It allows you to harvest losses from individual stocks as opposed to ETFs or mutual funds. Those losses carry forward on your tax return indefinitely, and you can use them really at any time. So you can offset $3,000 of your income every year, but more importantly, you can just bank losses on a carry forward basis forever. And so if you have loss carry forward, you can unwind a stock position that maybe has a large capital gain. You can use those losses to offset it. If you have $100,000 of losses on your tax return and you've got $100,000 in a potential capital gain, if you sold a stock, you can net those out and make it tax neutral. So that's the first strategy that we see often that makes a ton of sense for clients in this situation.
And I'll give an example. If someone has $20 million and it's heavily concentrated, well, let's say they spend, I don't know, $300,000 a year just to live. $10 million supports that. So we would say, let's take 10, get it off the table and support your life. And this other 10, we're going to come up with some sort of exit strategy or leave a portion of it invested if you want to participate in the upside. So direct indexing, tax loss harvesting is definitely a very effective way to do that. We'll get into some more details on that. But Drew, if a client has, let's say they don't have this stock in a brokerage account, they have it in a retirement account, what are the tax implications and what are some strategies to minimize taxes?
Yeah, strategy is a good question. The strategy is, it's called NUA, which is net unrealized appreciation. And basically what happens is if it's only done in a 401k or an ESOP, but if an employee has a concentrated stock, their own company stock in a 401k, let's just say 50,000 of cost basis and 150,000 of gain, so overall 200,000. What they can do is they could move it to an individual brokerage account in kind, and then pay taxes, ordinary income, on just the basis of the 50 grand, and the other 150,000 would be taxed at long-term capital gains, which would save them a lot of money.
So if they didn't do that, they're going to take it out at income rates,
correct,
which would be 24, 32, 35, 37%, or in that example, they take it out, pay income tax on the basis, and then everything else going forward is treated as a capital gain. And they don't have to sell it. Do they have to sell it immediately, or can they hold it?
They can hold it. But yeah, majority of them do sell it in the individual brokerage account.
So that's a strategy if it's in a 401k.
And just to be clear, the 15% long-term capital gains rate ends at about $600,000 of income if you're married filing jointly. So if you're in that range, 15% long-term capital gains versus 32 to 35% ordinary income is pretty significant.
Right. There are some triggering events for that. You have to be 59 and a half, or there could be a death, which the beneficiary can do that. or disability, or separation from service. So that's basically leaving, retiring, or being fired.
So good strategy if it's in a 401k, and then
So get fired. That's the advice. No.
Get fired and move your stock out. So if it's in a taxable investment account, Ben hit on direct indexing and tax loss harvesting. So ideally, carve off some that you can direct index, rack up as many losses as you can, and then slowly erode the concentrated holdings to offset those losses, or offset the gains. Another strategy is just fire sale. And if it's at a gain, sell it, pay your taxes, and move on. That's really hard for people to do because they're generally pretty tied to this emotionally. But can be a viable option depending on net worth.
I think just peace of mind. I think that goes a long way for clients. It's just, I use the analogy of just getting chips off the table. I mean, if you're paying capital gains tax, that means you did something right. Like you've got a gain, and just, take some of that risk. It's a good thing. Exactly. So I just try to frame that. It's hard to wrap your head around, but if you can frame it like that, it does make a lot of sense.
I'm not much of a gambler, but if you're sitting at a blackjack table and you put $100 in and now you have chips of $1,000 sitting there, probably want to take some of them and put them in your pocket.
It's so funny you say that. I'll sit with people at a blackjack table. They'll buy in for a certain amount, and then they'll have winnings, and then they'll put their buy-in like almost on the side because they want to just play with their winnings, and they know like, okay, well, if my winnings go away, I still have what I bought in. People don't think of their investments like that. People don't think of, well, I only want, I want to protect my basis on my investment side. A lot of people don't think like that. So it's the same exact scenario as playing with winnings in your blackjack table, knowing that you've got your buy-in on the side versus selling off a portion of your appreciated stock, knowing that your basis is still there.
I'd view your basis as what number do you need to support your goals. So if that number is 5 million to support financial independence, whatever the goals are, that's what you take off the table and invest the rest in whatever you want. Okay, why don't we talk about the donor advised fund and how charity can come into play?
Yeah,
So,
this is huge. If you're charitably inclined, a donor advised fund makes a lot of sense. Think of a donor advised fund as basically an investment account that has to go to charity. And so really good things to think about when you're putting money into a donor advised fund is taking low basis stock that you've held for a really long time, or stock that's got a really big gain on it. If you move that position into a donor advised fund, you get an immediate income tax deduction on the amount in which you put into the donor advised fund. So if you put $250,000 into a donor advised fund, that year when you file your taxes, you're able to get that income tax deduction of $250,000. If you're in the highest tax rate, that's 37% off that $250,000 that you're saving. But more importantly, you're avoiding the capital gains had you had just sold the stock and donated the cash proceeds to the charity itself. So if you've got your basis is $50,000 and your market value is $250,000, that's a $200,000 capital gain that you're avoiding because the charity receives it completely tax-free. So that's kind of a two-way tax benefit to the donor advised fund. It also allows you to take a big itemized deduction the year in which you do it. So if you're charitably inclined and you've got a stock that you've held for a really long time, a donor advised fund makes complete sense. The only kind of caveat here is that once the money is in the donor advised fund, it has to go to a charity. You can't kind of pull it back into your ownership.
It's a good way of educating your kids too on helping out and giving to the charities along the way.
Absolutely.
So yeah, donor advised fund's a good option. So let's talk about if you don't do that and you're not charitably inclined, you just want to hold the stock. So you could sell the stock and pay capital gains taxes. You could hold the stock and die. So one recommendation could be to die. I'm just kidding. Don't do that. And you get a step up in basis to
explain that though, because that is.
So if you have a stock that has $1 million basis, it's $2 million, and while you're living, you sell it, you pay taxes on that $1 million of growth. If you die and it goes to children, now their basis, instead of it being $1 million, is $2 million, and then they pay taxes on anything going forward.
So if they hold it and it goes from $2 million to $2.5 million, their gain's only $500,000. Whereas if if they don't have that original $1 million that you had, so big tax.
Or if they sell it, after you die, they barely pay any taxes.
Right.
Yep.
Which is huge.
That does not apply if you gift it, and that does not apply if it's in a trust. So irrevocable trust. Other options are you can do this a little bit more complicated, but can be done. It's called an ETF tax-free swap. So essentially, there's generally minimums to do this. Like I don't know what it is, might be $1 million, a couple million, 5 million. But you essentially, let's say you have some stock that you have a big concentrated position, you have $1 million basis, it's worth 5 million. You can take that stock and give it to a fund manager, ETF or mutual fund. And in exchange for that, that stock goes into the fund and you get the same market value of that ETF. So what does that do for you? Number one, you don't have to sell it and pay taxes immediately, but it gives you an instant diversification. So for example, let's say you had, I don't know, one of these Mag 7 tech companies, you exchanged it into, let's say QQQ, for example, which is an index that follows tech. Now, instead of holding that one position of $5 million, you now have $5 million in this tech ETF, which gives you some diversification. You're not heavily concentrated in that one company. You still have the same basis. And I would say the main reason that this would make sense is if you say, okay, I have money that's going to go to children and I want to get that step up in basis. I don't want to sell this, but I also don't want this stock to get cut in half. So exchange it, get some diversification, it appreciates, and then it goes to kids tax-free or with the step up in basis. And then what other strategies?
This one's not a strategy, but I have actually printed out here best performing stocks in the S&P 500 over 5 years, 10, 15, and 20. And just to kind of give people an idea, over the 20 years, NVIDIA is up 75,000% in the last 20. And in the last 5, it's up, almost 1,200%. So when we talk about concentrated positions, there are many people that have these concentrated positions. I've been asked many times, when do you sell or when do you get out of it? I'm not here to kind of guess, just because of, over the last 20 years, it's been up 72,000%. So it's more, from my end, it's more timing the markets better than timing the market, keeping, a financial plan and doing what's right.
Yeah. No, that's a good point you can't tell what's going to happen. And I would say if the stock's accumulated a bunch of wealth, it did what you wanted it to, and now let's protect the wealth. There are some option strategies that we won't get into all the details, but you could, not an option, but you just put a stop loss on it would be one. So you say, okay, stock's trading $100 a share. If it hits 90, it's just going to trigger and sell. That takes the emotion out of it. If you do an option strategy, like one way would be use a covered call. And so that would generate some income. It would trigger a sale at certain prices. And as a way just to hedge the risk of that concentrated position while still creating an income strategy. So that's a little bit more nuanced, and there's a bunch of different ways to structure options. You really need to understand the options and then make sure you get one that fits your goals.
Yeah, and I would say that's a good choice for people that don't want to sell the position, like want to keep tracking it, but at the same time, you're almost putting guardrails on how much you can earn versus how much you can lose. So if you put like an option on, like a covered call, and the stock shoots up, well, you may be limiting some of your upside there, but more importantly, you're limiting the downside if it completely shatters. So, good option for someone that wants to stay involved in the stock as opposed to selling it outright.
And one of my other clients, it's kind of a good point, is sometimes it matters of which account you put it in, because we were doing Roth conversions for a while, and this client wanted to put 5 or 10% of a concentrated stock in the Roth, and what happened is it kind of lucked out, took off, and now it's all tax-free in the Roth, which is huge.
Yeah, definitely. If you can position it into a tax advantaged account, that's your best bet.
Yeah.
Anything to add that we missed?
I would say, just one other thing. It's small and it's relevant only in certain scenarios. But if you've got someone that's taken a sabbatical, or like they're just in like a lower income year, that your 15% capital gains rate's up to 600,000. So if you're in a much lower income year than maybe you have been in the past or expect to be moving forward, any stock that you sell in that year, you'd be at a 15% capital gains rate as opposed to a 23.8, anything over that. So just monitor your income. If you feel like you're in a lower income year, it could be a good time to realize some tax favored strategy there.
Yeah, definitely spreading it out over income years can be an effective strategy. You just have to balance the risk of, we don't want to wait on this and it drops 50% and now our goals are off track. It's a delicate balancing act. And I would say, to sum it up, number one, make sure your goals are supported with a properly diversified portfolio. Number two, a good rule of thumb is keep these holdings under 10% of your net worth. And again, that's net worth depending and goals depending, but that's a good blanket rule of thumb. And then don't keep one stock that's more than like 5% of your allocation is generally a good rule of thumb as well. So we've seen this becoming more and more common just because of this tech and AI boom that we've seen over the last 10 years, really. So if you have any of these complex decisions to make on how to exit, feel free to reach out. We've come across this a number of times and look forward to looking for a solution that best fits your goals.